All right, welcome back to another episode of Asset Coach and Tax Strategist. And whew, these last few weeks been pretty powerful. At least they have been for me. Hopefully they have been for you. And hopefully you're seeing the excitement, the joy of me just pouring in information into you, giving you as much as I possibly can. And some of it may be review. That's awesome. We always need the foundational review of what we're doing. Okay. One of the things that we do every week is we do what we call our L10 meeting. It's a leadership 10 meeting. And my leadership gets together in each of our businesses. Each business has a separate leadership meeting. And so we get together and we go through our VTO, our core values, what we're passionate about, who we are. Okay. And so we do that because it's a reminder of who we are. We want to be who we think we are and we want to be, right? Now, goals are a good example. And so if some of this is review, awesome. Let's build upon that foundational understanding. And there's always a little bit of twist and turn on how some people look at things that we may already have an understanding of. I can't tell you how many times I've gotten reading through a book and I'm like, oh man, what a great way to say this. This is way better than what I've been saying. And all of a sudden I've become better. I've become my future self to be able to become better for that next conversation with that next business owner and that next member. So huge and big shout out to that. So let's do a quick little summary of what we've talked about. So I got my notes over here. So we've gone through kind of an overview of economic termites, what this series is going to be about for you guys. We went through kind of the beginning foundations and cash flow, kind of talking about that. Then we dove into cash flow quadrant. Holy cow. I'm going to rewatch that a couple times. I just after recording that, I just felt like there's such amazing, positive, great energy that it was almost like an out-of-body experience. And so and I'm not trying to be over exaggerating and be dramatic. I truly believe that. I think there's just something we needed to hear in that. And there's points in time where I just didn't feel like it was me talking. It was a bigger power as God, the Holy Spirit, kind of pouring more into you through me as a tool. And then the last episode was Richest Man in Babylon, and just building on that foundation of 1929, a book that really we should be looking at, a century later and still talking about this and understanding this and what this means to us. So today we're going to dive into assets. Let's dive into assets and the stages, their stages of the rules. So now we're not going to go specifically into specific assets and specific rules of those assets, but I will probably use an example of one or two assets to help understand what the three stages of these assets are. Okay, so what's an asset? Well, an asset is anything of value, a resource of value that can be converted into cash. Robert Kiyosaki says exactly the same thing. An asset is something that can appreciate, grow in value, and turn into income. Now, I don't like the word income because income becomes taxable, but cash and cash flow is planable. Okay, so remember that. Income is taxable, cash flow is planable. And you're a business owner. And the first thing you want to do is richest man in Babylon is pay yourself first. That is where we want to look at cash flow, direct that cash flow into other assets. And we're going to talk about these stages of these assets today. If you allow it to go down the income funnel, which we'll do an episode on the income funnel, if you allow it to go down the income funnel, then guess what? It's become taxable. And you lose control over what that looks like unless your tax return has other assets and other incomes that have flown down each of those asset funnels to equate to lower taxes. That's not going to make any sense right now, but it will as we go through and we look at the income funnel. We look at how tax returns work and how that financial statement, the tax return financial statement, how that communicates how all your different assets work. And why I say the wealthy have more assets you have, the more of the tax code you get to use, the less taxes you pay. Just the way the rules work. But anyways, I'm getting ahead of myself. That not only is the cart before the horse, the cart is in a different county than where my horse is at. So let me back up here and get back to topic. Let's chat about it. So assets. And so assets, the income, we got to understand this. The income we generate dictates our expenses, or the expenses dictate our income. What do I mean by that? Well, if you're a W-2 employee, remember, you negotiated your value of expertise and time, and the company you're working for negotiated the value of dollars that they have and the need they have of that expertise. And the two of you negotiated, you came to an agreement, you're hired, they're paying you a salary based on the value of who you are, what you bring to the table. The same thing happens with business owners. The product and services that business owners sell and offer, there is a price point that both the consumer and the owner agree. That negotiation has been taken care of. Now, we all have personal expenses. And so sometimes our expenses get to a point because of life, whether it's inflation, taxes, bought a home, had a kid, lost the family, lost a job, or whatever events occur in somebody's life, expenses increase, which cause a lot of times the saying, oh, we got to get another job, or we got to make some other income. We need a side hustle. We need to do something to where our income is above our expenses. That gap, that corridor is discretionary income. We'll talk about that in other videos. Okay. But also, your income can dictate that. You can say, you could get out of college, or this happens with doctors. They get out of residency. They finally are making some money. What do? Rather than keep their lifestyle the way they are, they start upgrading their lifestyle. Oh, I get it. It's cringeworthy for me because I'm not in their shoes. But so many times, I'm making $450 a year now, and they buy the nice cars, they upgrade the cars, they buy a nicer house. It's like, oh, I get why you're doing it, but right? Makes it tough. But I get it. So that's what that sentence is saying. Now, assets create leverage for your overall plan, and that equates control. What do we want as business owners? Control. That's why we hate taxes and insurance, because those are the two areas of our business where we don't have control over what we pay or what we spend insurance and paying taxes. But you actually can have control over both if you know what to do. Most business owners don't. Okay. But assets create leverage for your overall plan, and that equates control. I love it. So what we want to do is understand that each asset on its own has its own rules based on the IRS guidelines of what and how they tax that asset. Okay. So we need to know what those rules of those assets are. But before we know what the rules for each of those assets are, we need to understand the stages of those assets before we say, okay, what the rules are. Okay. And so by understanding these rules, it allows us to develop a plan that create either a positive or a negative outcome. But either way, we know how to deal with that. Okay. The key is we know how to deal with that. Okay. So for example, let's say, remember you were a kid, and I had G.I. Joe, I had He-Man, right? I had little army figurines, toy cars, and I'd go in the backyard and I'd take my Legos and my Lincoln Logs, and I'd build these forts on the dirt. I'd create this whole thing all by myself, all on my own, and I'd have a heck of a time. I'd have so much fun. But then when my friend came over, he brought some of his toys and he added to what I had done, and we get to play together. Guess what? We buddied up. And how much more fun was that? Because we got to do what? Play off others' strengths and creativity and work together. Imagine if each of your assets did that. Imagine if you had one asset, two assets, three assets, and they all worked together to duplicate and multiply and compound your wealth. That would be awesome. That would be awesome. And what is that called? That is called velocity of money. Okay. So the reality is that when real investors do not park their money in one asset, or remember, we talked about cash and storing and all that kind of stuff. You need to move your money. Your flow of cash needs to be movement. And this is the velocity of money. Okay. And so when you're always having your money move in and out of new assets, your old assets create new assets, and you're compounding assets, then your velocity of money gets to a point where the compounding of your assets outpace your ability to earn. So I can earn this, but my assets are earning this. Woo-wee! That's huge, right? So a lot of times business owners come to us and their biggest asset is their business. They haven't used their business to create this velocity of money to where they create outside assets that earn more than what his or her business does. That's control. That's wealth, because that creates financial freedom, because you can decide at any point in time to get out of your business and your lifestyle doesn't change. Oh, but it takes some time. But let's talk about compounding and see what that means. So compounding typically refers to the increasing value of an asset due to the interest earned on both principal and accumulated interest. This phenomenon, which is a direct realization of the time value of money concept, is also known as compound interest. Compound interest works on both assets, here's the kicker, and liabilities. This is why we talk about debt and liabilities, having a plan and understanding what we're doing and using the debt for. The debt's not building assets, then this compounding is going to go against us. Okay. While compounding boosts the value of an asset more rapidly, it can also increase the amount of money owed on a loan. As interest accumulates on unpaid principal, it prevents interest charge. So we got parallel paths, right? Balancing the universe. So we got to understand that. So, all right. So let's talk about the 3 stages of an asset. Every asset has 3 stages: beginning, middle, end. Okay. But let's talk about that. So stage 1, you see an asset. And remember, what am I using the word asset? Investment. You see an asset. You want to buy it or invest in it, right? You at least a portion. You want to be part of it. That's the contribution. That creates your principal or your cost basis. Okay. So you have $100,000. Great. Well, let's not use $100,000. Okay. Let's use, we're going to use a 401k. Okay. We're going to use a traditional retirement account, 401k, as our guiding post. And the reason being is pretty much everybody knows what a 401k is. Okay. All right. So we got a 401k. Now, what happens is that, let's say we put in $10,000 into our 401k. What is that? That's stage 1. That's your contribution. That is your principal. That's your cost basis. You have $10,000. Now, awesome. Okay. Now what we want to do is, what happens? Well, this money is going to do what? It's going to accumulate. So let's say it accumulates at 8%. Okay. Now, again, not giving investment advice. I'm just throwing that out. 8%. I could use 100%. I could use 1%. Just using 8%. So let's not get all crazy and been out of shape here. All right. So I'm using my financial calculator here, and I'm going to say we're doing $10,000 and we got 8%. So I'm putting my 8%. Let's just say 1 year. Okay. Just for 1 year. And let's see here, $10,000 and future value. Boom. Okay. So what happens? Now, year 1, at the end of year 1, we have 10,800 is our new balance. Okay. So that's the accumulation. Boom. Now, from a tax perspective, remember your 401k is tax deductible, right? So this is no longer a part of your income. So let's say over here, you make 100,000 a year and you put in 10,000 into your 401k. What happens to your taxable income? Your taxable income is actually $90,000. Okay, that's what you're going to be taxed on. Okay, so we're earning 8% compounding. Now, have you also decided on, if I saved money on this, let's say you're in a 24% tax bracket, okay, and let's say 10,000, oh, it's $2,400. My smartphone has not made me so smart. There's your tax savings. Okay. Have you ever thought about actually taking this 2,400 and putting this into a separate savings account to earn a rate of return on that? Just a thought. I mean, you do have the whole 10,000 in here, but the savings of tax could be another part of the compound. But either way, we're in accumulation. So what did we accumulate? $800, didn't we? So that's pretty cool. So that's the second stage, right? Our 10,000, are we contributed? From a tax perspective, also think about this: is that what if I have an asset and I lost money? Well, in a business, and you can actually lose what you put into it, your principal, and not have a penalty. So either way, we earned 8%. So let's say the next year we earned another 8%. So let's say my payments, okay? So now what we're going to have $10,000, 10,800 times 8. Let's say we earned 8% again. Okay. So what happens now is that we earned on this another 8%, or $864. So when we add that to our 10,800, our new balance is 11,664. Okay. So that's accumulation. Boom. That's exciting. Now, depending on the asset, this asset has tax deductible, meaning you don't pay taxes on that. And it's tax free or tax deferred, meaning that the growth, the 800 and the 864, you made $64 on that $800. Okay. So that's what we're able to compound, and it keeps going and keeps going year over year over year. Now you hit your distribution stage, your third stage. I want to take income out. Okay. So let me say that we did this. Let me get my eraser here. We're just going to erase all of this. Erase, erase, erase. Boom. Okay. And we're going to say we did this. We got 8%. Congratulations, as an average return for the next 20 years. Okay. And so that's an R, sorry. And so let's look at that. Let's take a look at that and see what that would be. Okay, so let me redo my calculator here. I gotta clear it out. All right, so I got payments. We're doing 10,000. We're doing 8%. We did 20 years. And so over that 20-year period, we've generated and earned $457,000 and 619. There's your account balance. Okay. Now this is a 401k. So let's say you're older than 59 and a half. So you have access to this now, and you decide you want to take the funds out. Now, you didn't pay taxes on this. It was tax deductible. You didn't pay taxes on any of the growth. It was tax deferred. Now you're going to be distributing. You're going to take the money out as income. What happens now? Well, it's taxable. So let's say you take out $30,000. Awesome. And let's say you're still in a 24% tax bracket. Okay. So we take out $30,000 times 0.24, and you're going to pay taxes of $7,200. There you go. So you have a net of what? You have a net of 22,800. There you go. So the stages: contribution, accumulation, distribution. I used 401k as an asset, and based on the rules of this asset, dictate the taxation. Okay. So And I get to tax deductible, no tax on the 10 grand. So I save $2,400 each year, assuming a 24% tax bracket each year. I earned 8%. Let's assume that that was the average each year. Again, we're not giving investment advice. Over the next 20 years, it compounded and grew. I didn't pay any taxes on that growth and that compounding. And then I decided to take money out after the 59.5, which is the rule that we're allowed to do. And then I pay taxes at my income tax bracket at the time of distribution, which is, let's assume, was 24%. And I pay taxes and I have a leftover $22,800. Done. Done. That is how the stages work. Okay. Every asset goes through this. So real estate goes through this. Your business goes through this. Stocks, bonds, mutual funds, brokerage accounts, CDs, savings account. All the assets go through these 3 stages. Okay. And so that's important to understand. Now, what is the 3 great truths that we need to be aware of? Well, death and taxes. Duh, right? We all know that. But what's the 3rd truth? Debt. Debt is important to understand. And what I mean by that is not necessarily just your debt, but the government's debt. And why do I bring this up? Because the government's decisions, the economic termite of laws and regulations, changing rules midstream. If you click on the usdebtclock.org, here's what the US national debt is. It's all this. Oops, let me get my writing tool here. It's all this red here. All the green here is tax revenue, but all the red is debt. So it's important to understand as we go through this, and we're not going to spend time talking about that, understanding that death occurs, taxes occur, and debt occurs, not necessarily our personal debt, but the government debt, our environment. We need to be aware of that. And so when we're looking at economic termites, and when we're looking at, as we start going in the next episodes, talking about taxes, inflation, time, laws, and regulations, when we start looking at that, and we start looking at our assets and which assets do we want to put into this plan, we need to take all that into consideration. Going back to richest man in Babylon and saying, how do I protect my income? How do I insure against these issues? That sometimes these issues aren't my issues, but they do affect me. Got to be worried about that. So anyways, excited for the next episodes. We finally get to dive into taxes. Yeah. So excited to talk about taxes. I know you are as well. And, we'll talk about income funnel when we talk about taxes. So the income funnel will help describe the tax system and what we do. So anyways, have a blessed day.